Hi, welcome to Let's Talk Bonds, a weekly podcast from INR Bonds. I'm Arjun Patsati. And in this podcast, you'll come to, we'll talk about three things. One is the ultra low rates and the ultra loose money of central banks fueled a loan party. The second is that the loan party was funded by corporate bonds issued very largely to investors who are looking for extra returns, given that there were ultra low interest rates available in most of the highest safety assets. And the third is that what will happen to these corporate bonds and the investors who hold these corporate bonds, what will they face when the interest rates rise and the money vanishes from the system as inflation threatens the economies globally. Uh, Before that, let's start take you through what Let's Talk Bonds is about. It's about the options available to fixed income investors in India. And we'll talk about various levels in the markets, what are the returns available, and what is the best option that could be available to you in the current macroeconomic and investment environment. Um, do not forget to download our app, Quick Invest by INR Bonds, which gives you the best curated bonds by us through through our own research and analytical expertise, and we give you the most information and the most transparency and the easiest of in-app investment process.
It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR Bonds. Download the INR Bonds app to save better.
Coming back to the topic of the fact that is the loan mela driven by corporate bonds over. So in the last couple of years, as everybody knows, once the COVID hit, the central banks from US Federal Reserve to ECB to every other central bank, including the RBI, cut interest rates to record low and pumped money into the system by technically what is called expanding their balance sheets. So they just printed money and gave it to the market. So whenever the central banks print money and give it to the market, there is so much of money floating around. It's very cheap, and a lot of excesses tend to happen. So we saw excesses happening in equity markets. We saw excesses in happening in credit markets, where we saw, for example, junk bond deals falling sharply as more and more investors get bought into higher yields available on these bonds. And the reason they're called junk bonds is that they are fundamentally not as strong as other higher safety bonds. And the third is other areas like cryptos and many things. And there was also, economic bubble in real estates in many parts of the world, etc., uh, which is what the central banks wanted, but they never bargained for inflation. And one more thing that happened was that there was a huge number of fintech companies that promised loans to borrowers to digital experience at a very fast period of time. So most of these loans are personal loans, unsecured in nature, and they were given over an app in maybe about 30 minutes or less, because the fintechs, as their want, is making the customer experience the best, which is fair given that they were able to reach, the fintechs are able to go out to borrowers who have been traditionally not been able to get fund loans in the regular market, even the banks, etc., because of the cumbersome nature. And hence, that with fintechs coming up, many of these uh, borrowers who needed funds, given that the economy was expanding, example, MSMEs, small business owners, they needed to catch up on inventory, shore up inventory, needed working capital. And so fintechs were able to manage their requirements largely through the digital channels. And also they went out to the consumers in terms of giving out loans, or personal loans, loans for holidays, loans for education, loans for buying electronic goods, loans for shopping, loans for eating out, loans for everything under the sun. And it was all very fast. And these fintechs were funded by private venture capitalists and private equity investors. And many of them grew very fast as well. And they were also able to borrow money through the corporate bond market by issuing bonds to investors, because many investors were chasing higher returns, given that interest rates were at record lows. And they had lost so much of money floating around. Everything was doing well, so they had a lot of money to invest as well. And wherever these fintechs and many other lenders, even traditional lenders, were able to access the corporate bond market, then they got funding in terms of their own risk profile at relatively cheaper levels than what they would have got through the institutional market. And there's lot of these bonds that have been raised um, over the last couple of years, and this looks to be this would have continued if the inflation had not really pricked the bubble. So coming down to the corporate bond issuances, these issuances of fintech companies in India, or I'm not even saying fintech, I don't want to label it. A lot of these non-bank lenders in India able to access the corporate bond market through issuance of bonds, through market-linked debentures, which found a lot of favor with ultra high net worth investors. And they were able to raise funds where where they were able to then grow their balance sheets and on lend it to the borrowers, given that they were able to raise the funds at levels of, say, anything anywhere between 9 to 11%, or even higher if you take all the fees, etc., then they were still able to make a very reasonable margin on their loans, as given that they were very driven by technology. They were able to assess credit and also market these loans largely through the digital channels. Um, but the question is now, with again coming back to the main thing, where interest rates, which were ultra low, and inflation and liquidity, that is money in the system, at very high levels, and with inflation now raising its head and threatening economies, if when interest rates rise and money vanishes, what happens to these lenders? So clearly, one is that they may not be able to access the corporate bond market at the cheap levels they had were able to access earlier, and even more important, they would have to increase the uh, cost of their loans, which is already very high, and this may not go down well with the borrowers, who could, in fact, get hurt if the interest rates and money vanishes from the system, because there could be a lack of demand, and if this lack of demand hits, then their businesses could also see a drop in growth. But even more important, what happens to the existing loans that they have been given out? Can they be, will they be able to repay the loans taken by uh, taken from the lenders? With this, I'm talking about the consumers who borrow the loans, or they will also have a problem if the economy suffers in repaying the loans. One positive aspect is that most of these loans are very short term in nature, and before the whole scenario erupts in terms of interest rates rising very sharply and money getting withdrawn from the system again very sharply, the business continuity would be still there, cash flows would be still there to pay off the lenders, but they may not be able to get more loans at reasonable rates and they might have to cut down their um, growth, as I mentioned earlier. Uh, but coming back to the corporate bond market, then what happens to the investors who invested in the bonds of these lenders? Now, they had invested knowing that the risk is pretty high given that the loans are unsecured in nature. But given that interest rates was still very low and money was very easy, and they didn't see that inflation is going to rise very fast, they were able to take that extra risk in the whole in the knowledge that in the next at least 2 to 3 years, the lenders will not have any problem. But now, if things go really bad very fast, then the lenders could have problems getting liquidity to refinance their loans. And uh, uh, if this problem surfaces, and then the investors, corporate bond investors, then could see a lot of could see quickly drop in the portfolio value of the bonds, because one is definitely the yields will shoot up given that extra risk the markets will start to factor in, and prices of the bonds will come down. But even if they hold it to maturity, if the lenders are pretty much liquid and are able to have a stronger balance sheet and are able to access more money from their equity investors, then they would be able to clearly uh, service the loans. But some lenders who had gone over aggressive and in lending and borrowing, they could face issues. So corporate bond investors would have to be extremely careful now, given this macroeconomic scenario where the whole thing has changed. You have interest rates rising, inflation, money uh, coming out of the withdrawing very fast from the system, and inflation eating into economic growth and risk aversion, which is now already seen in equity markets and also seen in many corporate bond markets across the world, could also hit in India. So it's best to be, the investors need to be extremely careful on where they're investing in. Uh, Again, they are going to see a lot of pain because yields are still low. Central banks are still going very slow in raising rates and withdrawing money, but they might have to do it much faster if inflation is going to be rising very fast and not controlled, not getting controlled at all. So that's the biggest challenge the markets face now. Corporate bond investors also face this big challenge, and they would have to start demanding higher risk premium for investments in corporate bonds, especially for the lenders uh, who had a party for the last 1.5 years mostly. And if this party driven by central banks and central banks now going the other way, then this party could actually stop. Thank you very much for listening in. Do not forget to follow us on all our podcast channels, Spotify, Apple Podcast, Amazon Music, YouTube as well. And do not forget to download our app, Quick Invest by INR Bonds, for the best bonds available to you with the most information, transparency, and our own proprietary risk score, which factors in all these kinds of risks into the price, into the yields as well.